This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, July 27, 2026, and this is the New York session. Now, let's get into it. Bitcoin is clinging to $65,002, even as Bitcoin futures demand collapses to 2024 lows. Meanwhile, Ethereum and Chainlink are surging nearly 4%, defying an extreme fear reading of 14 out of 100. We're looking at a market where price action is sprinting, while sentiment is digging in its heels. Before we dissect the dissonance, let's look at the macro landscape waiting in the wings. Today, July 27th, the U.S. economy drops durable goods orders and the Dallas Fed Manufacturing Survey. These figures will test whether the recent softening in inflation expectations is holding firm. Then, looking ahead, we have the Case-Shiller home prices on Tuesday, the EFF OMC rate decision on Wednesday, and gross domestic product on Thursday. But right now, the data flowing into our screens tells a much more urgent story than the economic calendar.
And that urgency is exactly what's confusing the room. We have a textbook decoupling, traditional volatility. The VIX at 18.58 is sleeping peacefully, while the crypto fear and greed index is screaming at 14. Usually when equities are calm and crypto is terrified, we see a flight to safety in Bitcoin. Instead, we're seeing Bitcoin stall at $65,002, while risky alt infrastructure assets like Ethereum and Chainlink run hot. That tells me the fear isn't coming from the charts, it's coming from the headlines.
Let's ground ourselves in the data as of 9/19 ET. Bitcoin sits at $65,002, up just 0.8% on the day. Ethereum is the clear leader at $1,955.69, gaining 3.7%. Chainlink follows suit at $8.74, also up 3.7%. Solana is higher at $76.70, plus 2.5%. Meanwhile, the laggards are clear. Polkadot down 1.9%, Cardano down 0.7%, and Dogecoin down 0.6%. Total market volume is heavy at roughly $55.20 billion, but Bitcoin dominance remains static at 56.4%. Let's start with the biggest red flag in the data, the collapse in institutional engagement. Pulse, walk us through the sentiment. It's a paralysis scenario. The fear and greed index is stuck at 14, which is deep in extreme fear territory. What's striking isn't just the low number, it's the divergence. Normally, a 3.7% jump in Ethereum and Chainlink would push sentiment out of the gutter. Here, it hasn't budged. That tells me the buying pressure is narrow. It's not broad retail enthusiasm, it's a small cohort absorbing supply, while the wider market is paralyzed by the narrative of the 700% spike in Iranian crypto, outflows following the U.S.-Israeli airstrikes. The crowd is watching the geopolitical door crack, not the blockchain.
And that geopolitical door is leaking liquidity. CIPHER here. The headline data confirms it. Bitcoin futures demand has hit 2024 lows. Do not underestimate how hollow that base is. You have $55 billion in total volume circulating, yet it is bypassing the anchor asset. Bitcoin is barely moving 0.8% of the secondary infrastructure layer pumps. Where is the money going? It's rotating into utility. Look at the TD Securities report regarding NYSE tokenization as an institutional turning point, and look at Link jumping 3.7%. Capital is fleeing leveraged Bitcoin exposure and moving into spot settlement layers. But here is the risk. If those Iranian outflows result in forced exchange liquidations, that spot liquidity evaporates instantly. We are trading on thin ice.
Thin ice is an understatement. SPECTER here. We need to audit this rotation thesis immediately. Grid and CIPHER seem comfortable calling this a sector rotation into quality assets like Ethereum and Chainlink. I see a liquidity trap. You have a VIX of 18.58, which suggests equity markets are complacent. You have a fear and greed of 14, which suggests crypto markets are panicked. And you have a Bitcoin price that is essentially flat at $65,002, despite massive volume elsewhere. That flatness is deceptive. It implies there is no bid wall at $65,000. If those Iranian outflows translate into actual sell orders hitting major order books, that $65,002 level doesn't bounce. It gaps. The 2024 low futures demand means there are no institutional hedge funds stepping in to catch the knife. This isn't a rotation, it's a vacuum.
So we have a vacuum at the top, with liquidity chasing the middle tier. Let's look at Ethereum. It's at $1,955.69, up 3.7%, with a 24-hour range of $1,885.52 to $1,973.07. Grid, how does the structure hold up?
Structure is interesting because it's rejecting the broader market weakness. Ethereum is testing $1,973.07, which is near its 24-hour high. The key here is the separation from Bitcoin. Usually when Bitcoin is churning at $65,002, alts bleed. Ethereum is bucking that. However, look at the intraday candle structure. It's pushing into resistance at $1,973.07 without a corresponding expansion in overall market depth. The volume is concentrated in Ethereum, yes, but it's isolated. If Bitcoin decides to reclaim its role as the king and breaks below $65,000, Ethereum's relative strength will vanish. It's holding a candle, but it's holding it alone. Support needs to be established closer to $1,885.52, which was the early session low. Until Ethereum closes decisively above $1,973.07 on higher timeframes, this looks like a liquidity grab before a mean reversion.
I agree it's isolated, but let's look at the counterparty. The core issue isn't just Bitcoin, it's the CBDC narrative clashing with utility. CoinDesk reports the U.S. Senate housing bill includes a CBDC ban. This is fundamentally bullish for decentralized, permissionless ledgers like Ethereum. The market is pricing in a regulatory hedge. XRP is up 0.4% at $1.10, reacting to that same political wind. But Ethereum is moving faster because it's the infrastructure layer for the tokenization trade TD Securities is highlighting. So, Grid, your support level might shift. If the political narrative hardens around no CBDC, the bid for Ethereum strengthens structurally, not just technically.
But CIPHER, you can't ignore the psychological weight. The community sentiment isn't celebrating the CBDC ban yet. They're scared of the geopolitical fallout. The 700% outflow from Iran is dominating the discourse. People are worried about sanctions enforcement and exchange compliance. That fear suppresses the reward side of the sentiment equation. Even if the fundamentals for Ethereum are improving due to the Senate vote, the crowd is still looking at the map of global conflict. That creates a ceiling. Buyers are hesitant to chase $1,973.07 because they're worried about the second shoe dropping. Moving to Chainlink. It's also up 3.7%, currently at $8.74, having traded between $8.45 and $8.88 in the last day. This is a twin peak with Ethereum. Why is Chainlink moving in lockstep?
Because Chainlink is the railroads. While Bitcoin is the gold reserve, Chainlink is the toll booth. The TD Securities report specifically cites NYSE tokenization as an institutional turning point. Institutions don't buy memecoins or legacy L1s like Cardano to tokenize assets. They build on infrastructure. The $8.88 high suggests that algorithmic trading desks are front-running the institutional adoption narrative. This is flow-driven, not hype-driven. The volume here is sticky. Unlike the speculative churn in Dogecoin or Cardano, which are losing ground, Chainlink holders are resisting the sell pressure. The on-chain metrics show accumulation in the wallet clusters associated with institutional custodians.
Technically, $8.88 is the immediate friction point. We've seen multiple tests of this level recently. The fact that it held $8.45 as support during the dips earlier in the session is bullish structure, but the proximity to $8.88 creates a double-top risk if volume dries up. And here's where I push back on CIPHER's sticky volume argument. Look at the broader picture. Bitcoin dominance is static. If the broader market cap doesn't expand beyond $55 billion, this kind of vertical move in Chainlink becomes unsustainable. It's a relative outperformance, but without a wave of new money entering the entire market, it's likely to face sharp retracements. It's a high beta bet on a macro theme that might not play out linearly.
I want to address the risk in this institutional turning point narrative. CIPHER, you're talking about custody and tokenization. But remember, Core Scientific turned lower after disappointing Q4 results. The mining sector, the physical backbone of these networks, is showing cracks. When energy costs rise and profitability squeezes, the hash rate drops. If Chainlink is pricing in a future of massive tokenization, it is ignoring the present fragility of the miners securing the network. Furthermore, the Senate housing bill is a messy legislative process. Adding a CBDC ban to a housing bill is political theater. Markets hate uncertainty. If that bill stalls or gets watered down, the regulatory premium you're seeing in Chainlink and XRP could evaporate overnight. You're buying a policy win that hasn't happened yet.
That is a crucial check on the regulatory trade. Let's pivot to Solana. It's at $76.70, up 2.5%, with a 24-hour range of $74.85 to $76.97. It's performing well, but not quite matching the double-digit percentage moves of the top movers. What's happening with Solana?
Solana is behaving like a high beta follower. It's up 2.5%, which is strong, but notice the upper wick on the daily chart approaching $76.97. It's struggling to break that psychological barrier cleanly. Compared to Ethereum's decisive move toward $1,973.07, Solana's movement feels more reactive. It's catching up to the momentum set by Ethereum and Chainlink. The support zone is clearly defined around $74.85. As long as it holds that, the uptrend is intact. But the lack of breakout above $77 suggests profit-taking is aggressive here. Traders are taking chips off the table as soon as it touches the highs, unlike the hold-your-horses attitude we see in Ethereum.
It's also competing for the same liquidity pool. Remember the Iranian outflow? That 700% spike often funnels through high-throughput, low-cost chains first. Solana is a prime destination for rapid, cross-border speculative flows. The volume in Solana isn't just retail, it's likely mixed with regional capital seeking speed. However, this also makes it vulnerable. If those flows reverse, say, due to new sanctions announcements, that volume can vanish in seconds. Solana is great for liquidity when it exists, but terrible when it flees. The data shows healthy activity, but it's noisy activity.
And that noise is exhausting. Retail traders are tired. Look at the laggards. Cardano down 0.7%, APT down 0.9%. The market is pruning the weak links. Solana is surviving, but it's not immune. The sentiment around Solana is cautious optimism. It's not the love child of the market anymore. Ethereum is reclaiming that title. Solana is being treated as a viable alternative, yes, but the enthusiasm gap is widening. The crowd is watching Ethereum like a hawk. If Ethereum stumbles, Solana doesn't just fall. It crashes harder because it lacks the institutional anchor that Ethereum has built over years. Let's look at the losers to understand the exodus. XRP is holding steady at $1.10, up 0.4%. But Polkadot is down 1.9% at $0.80, and Aptos is down 0.9% at $0.62. Why are these legacy and parallel chain narratives underperforming?
It's a clarity vs. complexity trade. XRP is moving slowly because it is a single-purpose legal instrument in many people's minds. It's riding the CBDC ban news as a shield. But Polkadot and Aptos require deeper technical understanding of interoperability and sharding. In a risk-off environment, or what feels like one due to the geopolitical noise, capital flows to simplicity. Bitcoin is simple. Ethereum is simple. Chainlink is simple. Polkadot's parachain auctions and Aptos' move language are complex narratives that lose appeal when investors are scared. The data shows capital is exiting complexity and seeking simplicity. That's why Polkadot is underperforming while Chainlink rises. One is infrastructure, the other is a platform for developers who haven't found product market fit yet.
Or it's a liquidity depth problem. Look at the bid size on Polkadot. With Polkadot down 1.9%, the order book is thinner. Small sells can move the price significantly. Compare that to Ethereum, where billions in liquidity absorb the shocks. The drop in Polkadot isn't just sentiment, it's a function of illiquidity. When the market turns, these assets get dumped first because there's no one left to catch the falling knife. The clarity argument is nice, but the math is brutal. Low volume equals high volatility. In an extreme fear environment, high volatility is fatal for portfolio preservation. Polkadot isn't just lagging, it's becoming irrelevant to the main market narrative.
So we have a market split between the safe harbor of Bitcoin, even if stagnant, the growing fortress of Ethereum/Chainlink, and the dying embers of legacy L1s. Before we close, Apex, tie this together. How do we reconcile the 14/100 fear score with the green candles on Ethereum and Chainlink?
We reconcile it by recognizing that we are in a micro-risk-on environment inside a macro-risk-off world. Grid highlighted the technical divergence, Ethereum breaking resistance while Bitcoin stalls. CIPHER explained the flow mechanics, funds moving from leveraged Bitcoin and complex chains into spot infrastructure and utility tokens. Pulse identified the driver, geopolitical noise keeping the crowd scared, but not scared enough to start buying quality assets. And SPECTER warned us about the fragility of this setup. The lack of futures demand means this rally has no cushion. The synthesis is clear. The market is rotating capital away from speculation, Dogecoin, Cardano, Polkadot, and towards utility, Ethereum, Chainlink, Solana. But this rotation is happening on empty stomachs. The extreme fear score is accurate because the foundation is shaky. We aren't seeing a broad bull market. We are seeing a desperate search for yield and security in a chaotic world. Position accordingly. Respect the fear but trade the utility.
Strong synthesis. To summarize, Bitcoin is anchoring at $65,002 amidst collapsing futures demand. Ethereum and Chainlink are leading a structural rotation into utility, driven by institutional tokenization narratives and regulatory hedging, despite an extreme fear sentiment score of 14. Watch the $65,000 level on Bitcoin. If it breaks, the altcoin rally faces immediate liquidation pressure. And keep an eye on the Senate housing bill developments and the Iranian outflow data for sudden liquidity shocks. Tomorrow, we'll see how the market reacts to the continuing debate on digital currency regulation and the broader economic data from the Dallas Fed. This has been ShadowQuant Crypto Edition. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.